Oh, thank you. This is Senate Finance on January 20th. Senator Cummings will be joining us shortly. The budget just was dropped, and I believe she is with the pro tem, just discussing some of the things that were just revealed. She did ask me to start the meeting off, so I'm really excited to turn the floor over to Senator Hardy to introduce us to S231.
Thank you, Mr. Vice Chair. S231 might look familiar to everyone around this table. It is a new version of a bill that I introduced last year that several of you were co-sponsors of, and that passed this committee and then the full Senate unanimously, and then got stripped out of the bill in the House and turned into a larger tax package. But this is the caregiver tax credit. And this is a new and hopefully improved version of the bill that we looked at last year. You might recall that last year it was a refundable tax credit for taxpayers who were what is called, and it's defined in the bill as the unpaid caregiver. These are people who are caring for members of their own family who have either chronic illnesses or are disabled and are not able to care for themselves by themselves. So often this is a spouse caring for another, their spouse who has dementia, or it could be a parent caring for an adult with disabilities, or a sister caring for her uncle. It could be a lot of different combinations of people caring for other family members who are not able to care for themselves, but who are not paid to care for their family members. So it would, if somebody's being paid or they're getting SSDI or any kind of or choices for care or programs like that that pay you to take care of family members, this isn't for them. This is for unpaid caregivers. And this would provide the Vermont Family Caregiver Tax Credit. As I mentioned before, the previous version was a refundable tax credit that I think we ended up with $1,000 refundable tax credit. Means you get that tax credit even if you don't file taxes. You have to claim it, but even if you don't have a tax liability, you can get the refundable tax credit as a payment. This is not that. This is a tax credit based on expenses. So if you have expenses for taking care of someone, then you could get a credit to cover up to, and the starting point in this bill is up to $2,500 in expenses for caring for somebody. And there's a list of qualified expenses, and it's very similar in structure to the Child Dependent Care Credit, which is a federal credit that we also mirror in our state taxes. So we've had some testimony on that. So it's structured in the same way. And it slopes down after $125,000 up to $75,000 in income, similar to the child tax credit, other tax credits we have. It slopes down by $50 for each $1,000 of income. So after 125,000. So that's similar structure we've seen. There are some definitions that Kirby can go through and explain some of the details of it, and also the expenses and why these expenses are included. I tried really hard with the assistance of Kirby and also Pat Titterton to address some of the concerns that we heard the tax department bring up last year about the administration. So this should make it easier because it's a very familiar construct to them. And then there is another provision in the bill that was not in last year's bill, but came as an idea from a constituent of mine. And this is actually related to the work we've been doing on property taxes. As you recall, for property taxes, there's a definition of household income, and it's basically the income of everybody living in a household. So if your mother moves into your household because she can't live by herself and you're her unpaid caregiver, she's a member of the household and her income would count for the household income for calculations of the property tax credit, or in the future, if we do move to it, the property tax exemption. And what this would say is if you qualify for the dependent care credit that I just discussed, you can deduct the income of the person you're caring for who's moved into your house. So your mom, if she's moved in, from the calculation of household income, so that her income wouldn't push you above the threshold to qualify for the property tax credit. So if you're making $60,000 and her income pushes you above the tax credit threshold, then you can exclude her income if you are also applying for the caregiver tax credit. And I tied them together to make it easier for the tax department to understand who's eligible. So that, and it probably will be a narrow slice of people, but it would be property tax relief combined with income tax relief for people who are unpaid caregivers if they qualify for both. So that is the bill. I'm going to take it back for this tax year as the drafted. And I mean, we heard a lot of testimony last year about the reasons for all of this. You know, from, I know the AARP and the Alzheimer's Association and the Vermont Women's Commission are all interested in the bill again. They all testified last year. I had my awesome student testify. I'm sure she would come back too. But we heard a lot of testimony last year, and this is just the same concept, but a little bit different construct.
Question. Now, there's another tax bill, and that's the one, Martine, you.
Yep, you and I are both.
Yeah, we're both. And of course, you know, if they both pass, they really almost conflict one with the other. And I think our intent is go with the winner.
Yeah, I mean, the other bill is not a tax bill.
Yeah.
The other is a grant for, and it's
Correct.
much more narrow. It's for people who are specifically for dementia caregivers.
Correct.
And this is broader. This is all unpaid caregivers, and that would be a grant to pay for respite care.
Mhm.
And this is a tax credit to cover expenses related to caring for an individual.
I think just the one thing that I would caution is that doing both may be excessive. If we do that, and
I
agree
I
that
think
there
that's
are
all in the big
purposes.
picture. I mean, I think they're not the same
no, I
population.
understand.
Yeah.
I have a bill 269. It's exempting supplemental security income from the payments from the household income determination for the property tax credit. It somewhat falls into this arena. So if this does move forward, I'd love to just hear from the constituents that are advocating for that. I think that too is a small slice of the population, but I think it's very relevant to what you're trying to do.
SSI, is that? Yeah, okay. Yeah, I mean, it's similar. I think that would be a larger. Yeah.
Senator Mathis, you're raising your hand there.
Yeah, what, so I'm along the lines of the property tax credit. If we're thinking about it, so you want to exclude the income of, say my mom moves in with me. I take care of her, exclude her income from my household, household income. So what, just logically thinking, say my mom's getting $40,000 in retirement, social security, whatever it is. In theory, wouldn't that money be going to help me care and pay the bills and things like that?
It's possible. Now, just because you're excluding her income doesn't mean you're going to automatically qualify for the tax credit, because you probably make more money than you probably don't qualify for the tax credit. If you're just talking about you.
I'm using your example, $60,000.
Oh, I
Everyone's
see.
tax
I
liability
see.
different.
Yours is 60,000.
But
Okay.
using your example earlier, say you make 60 grand or $70,000 and your mother who comes in makes 60 grand every year.
I see. Okay. You're not talking specifically about you.
No,
Okay.
my mom was at home with my dad.
I think that, yes, one could make that argument. And I think that, this is trying to get at, this is a service that is helping somebody stay out of a much more expensive long-term care facility, whether it be a nursing home or an assisted living place that is a lot more expensive. So the sort of benefits that you're providing by caring for your mom at your home
Yeah, get that.
is offsetting that.
But I'd imagine a parent moving in with a child that's gets 60,000, say 60,000, would be helping with the expenses of the home they moved into. Mitigating the effect of losing that credit, so to speak.
It's entirely possible, but this was just similar to the what Senator Chittenden bill was considering was but this is a narrow slice of people because they would have to qualify for the other credit in order to qualify for this credit, so that the tax department can track them.
And does anybody know, I don't know where I saw it. I'm hoping I'm not making it up, but like program where is it the federal government pays you for caring for a family member?
There's a program called Choices for Care, which is through Medicaid.
Yep.
And there was an article in the paper a little while ago,
Okay.
which you may have been read, which I thought was really interesting. Yes, so Choices for Care helps people pay for nursing home or home health and hospice, or in some cases for an individual to pay to care for their own family member. There are specific income requirements for that and specific sort of types of care requirements. And you have to apply for it and qualify for it based on the income of your family member and the type of care you're providing. And it's a Medicaid program, so it is limited. But yes, and if they qualify for that and they're getting paid to take care, they wouldn't get this because this is for unpaid caregivers. And in that case, they'd be considered paid.
Yeah. Okay. I'm just curious if there's other avenues out there.
There are. This is just broadening the avenues.
Other questions before Kirby starts walking through the bill?
Kirby, you can correct anything right stage.
Okay. Been working sick for about 8 weeks in a row now. I forgot to take my meds this afternoon, so I'm probably gonna sound a little different. Kirby Keaton, Legislative Council. My plan here is to walk through the language of the bill for you. S 231. I have a little chart because as Senator Hardy mentioned, this is drafted to be a supplement to the Child Independent Care Credit, which is a federal credit that Vermont also has a Vermont version of. So it's meant to cover entirely different expenses on purpose than the CDCC. And so the chart I think will help show you the difference there. And I'm also going to touch on the federal changes to the CDCC under the HR 1, because I'm sure we'll be getting into these federal changes more in this committee later, but this is a good opportunity to show you a little bit of that too. So with that, we will move forward. An act relating to a family caregiver tax credit. The credit that Senator Hardy referred to from last year that was proposed was called the unpaid caregiver. This is different because it is no longer about unpaid care. It is about expenses incurred in taking care. So the name was changed, family caregiver. So as far as the way it's drafted, it's not directly trying to pay for unpaid care, even though the demographic being targeted is believed to be people who are not being compensated for the care they're providing. So we have a statutory purpose, as all tax expenditures such as tax credits have to have. And then in section 2 is the credit. So this is a refundable credit, a Vermont credit, obviously. It's limited to expenses, as we said, that are qualified expenses, and we'll get into what that means under this section of law, but also expenses that are not creditable to the CDCC. And So right off the bat, you see that if anything is claimable, whether you claim it or not, under the CDCC, then you cannot claim it with this credit. That goes to, we'll get into it with the chart, but the basics of the CDCC are, those are expenses that are, for qualifying person, which is a dependent child, under age 13, or a spouse or older dependent, physically or mentally incapable of self-care. But that's limited, so it's limited to dependents or spouses in some cases. And those expenses also must be related to work or looking for work. So that means this credit would not cover those expenses. If it's related to work or looking for work, or if it's for a dependent, you would not be able to claim those expenses here. Because there's already a credit for you to claim those expenses for. Moving on, the amount of credit available under this section is 30% of qualified expenses paid by the taxpayer for an individual with long-term care needs. We'll get into what that means. Maximum credit per taxable year is $2,500, and then it's divided out for part-year residents, prorated out. There's a phase out, as Senator Hardy mentioned, starting at AGI of 125,000, and then that phase out ends at 175,000. And so after an AGI of 175,000, taxpayer would not be able to use this credit at all. The maximum allowable credit is inflated under this. There's under subdivision C3 there. And then we get into the definitions. So activities of daily living. These are, actually, I'm not going to go in alphabetical order because that makes a lot more sense when you see some of the other definitions. So we'll start with individual long-term care needs. That is, the person being cared for has to be under this credit an individual with long-term care needs. So they are at least 14 years of age, which because the CDCC is for 13 and younger, is related to the caregiver by blood, civil marriage, or adoption. You'll notice that does not mean dependent. It just means being related, unlike the CDCC. Has a medically diagnosed disability or health condition, and does not reside in a residential care home. I would note there that the person may or may not be living with you. This is about expenses for caring for another person. It's not about whether they live with you or not necessarily. More requirements: is unable to perform without substantial assistance from another individual at least 2 activities of daily living due to functional capacity, or requires substantial supervision to protect the individual from threats to health and safety due to severe cognitive impairment, and is unable to perform without reminding or cueing assistance at least 1 activity of daily living. Some of these requirements come from proposed federal legislation in the past. So just to let you know that there's an origin for some of these concepts. We didn't make this up entirely for the sake of this credit, where this is borrowing from proposed federal legislation in the past for a similar type of credit. With that, I'll revisit activities of daily living, but we'll stop there.
Is back down a little bit. The daily living, at least one, is that cognitive impairment? That's just like a dementia or memory loss or something like that.
Requires substantial supervision to protect the individual from threats to health and safety due to severe cognitive impairment.
Again, like Alzheimer's, where is that kind of like that realm is looking at that?
Yeah, Alzheimer's or dementia or some kind of disability that is cognitive impairment. And there are lots of other.
TBI. Would TBI go?
I would, if this needed to be interpreted, I think you could take a pretty broad interpretation of severe. I mean, severe is not, but severe cognitive impairment, any impairment to your ability to think or use your brain. But it has to be severe, and the more measurable part of this, I think, is that they're impaired when it comes to at least one activity of daily living. And so what those activities of daily living are defined up here. That means tasks such as eating, toileting, grooming, dressing, bathing, and transferring, and meal planning and preparation, managing finances, shopping for food, clothing, and other essential items, performing essential household chores, communicating by phone or other media, and traveling around participating in the community. So it has to be one of those things when it comes to both. Well, the E and F are or, so I'll flag that. The first four requirements are all together. You have to meet all of those. And then when it comes to E and F, it's one of the two. Which maybe if we end up working on this drafting wise, maybe I should break those out into subdivisions to make that more obvious that we have an or at the end there. Maybe it should be E1 and 2. So let's criticize my own drafting as I go here. Anyways, returning back to these ors, that's where the activities daily living. So it's unable to perform without substantial assistance, at least two of those things we just read, or require substantial supervision to protect them from health and safety due to a severe cognitive impairment. And then in that only one of the activities needs to be something required to help. Going into qualified expenses. So these are the expenses for which you can claim as 30% of your expenses for the credit. Again, any expense that's covered by the CDCC already would not be something that you could claim. So qualified expenses means expenditures for goods, services, and supports that assist an individual with long-term care needs with accomplishing activities of daily living. May include reasonable expenditures for goods, services, and supports for the caregiver. So this is unlike the CDCC, or at least parts of it. There could be some caregiver supports that are also qualified expenses here. Qualified expenses include expenditures relating to care, such as respite care, adult daycare, counseling, support groups, training, lost wages, or unpaid time off due to providing care as verified by an employer. So there is some loss of compensation due to work here, but it requires employer verification, which is something maybe Department of Taxes would care about as far as the administration goes. Like, how do you expect us to track this? Well, you can require it to be verified by the employer if they're going to claim it as an expense here. Travel costs related to care and assistive technologies. So these all should be expenses that have some sort of invoice or receipt associated with them that can be proven, which is meant to help with the administration of this. For purposes of this subsection, goods, supports, and services means, and then you have these examples. I won't read through all of it, but these are all examples of goods and supports and services that would be allowed as qualifying expense. There is a provision that the Commissioner of Taxes may require substantiation of any expense claimed and may deny a credit or a portion of a credit based on a lack of credible documentation. And then lastly, reinforcing the supplemental relationship between this and the CDCC. We have a provision saying a taxpayer looking to claim the credit in the section may also claim, this is Vermont's 5828C is Vermont's child and family care credit. They may claim them both, provided all of the expenses claimed under this section are separate and distinct from the expenses claimed under the child and family care credit. Section 3 is the component of it that goes to the property tax credit, which, and if Act 73 proceeds as expected at this point, will become the household exemption or the household exemption instead of the property tax credit. But in either case, Vermont will continue to use household income as a way to determine whether a person qualifies. And in this case, it changes the definition of household income to exclude a person residing in a household who meets the definition of individual with long-term care need that we discussed before, and also has a member of the household claiming that person to receive the credit that we're talking about before.
So if I'm a millionaire and I have long-term care needs. And I would like my spouse to provide. My income can be excluded. Or.
No, probably not. Well, I mean, depends on what kind of millionaire you are. If you're one that has a lot of income, no. If you're one that has, through some estate planning, maybe made it so that you have
Yes.
basically no income on paper, but you have a lot of wealth, then maybe.
Maybe, okay,
But part of this is written so that a member of the household has properly claimed a credit for you. But if in your scenario, your spouse who's wealthy would not be able to claim the credit because you can't claim a credit if your AGI is over 175,000.
okay. I missed the first part of this.
But up to an AGI of 175, a person can claim the credit and then could use this other part. If you've got all the other.
Anything, say anything about long-term care insurance?
No. So that's it for the credit. So that the chairs here, I'll say my plan was to walk through the credit as it's proposed, and then the way that this credit is structured is that it's for expenses, and it's for expenses that are not covered by the child dependent care credit. So I was going to show you a chart next to compare those two things so you can see the differences in the types of expenses that can be claimed under each one.
Got about 4 minutes.
Oh, do I?
I thought we were gonna have time in between, yeah. Yeah, I've got Maria coming in at 2:40. Maria's here. Who's that mirror? Oh. What's the window?
All right, let's get through this chart in 4 minutes. The column on the left is the Vermont Child Dependent Care Credit, which piggybacks off of the federal credit. And then on the right is the Family Caregiver Tax Credit being proposed here. Let's jump to the second row, which is the maximum credit amount allowable. Under current law, this is not taking HR1 into account. The maximum credit's about 1,500. Actually, it does take HR1 into account because HR1 didn't actually increase the credit limits actually. So that for that, you can say it's about the same. 1,500 is the maximum credit under the child dependent care credit. This credit has a maximum of 4,500. To get that 1,500 credit for the child dependent care credit, you would need at least 2 qualifying individuals that you're caring for. Just on note. The amount of or the percentage of expenses that you can take a credit for under this credit, it's 30% of expenses. For the federal credit that flows through to Vermont, it up until HR1, it was between 20 and 35%. HR1 changes that to 20 to 50%. I would note that the 50% level though is for the lowest of incomes. And since it's non-refundable at the federal level, you can't actually claim 50% of expenses because you don't owe enough tax to actually
So
use all
that
that
is
credit.
not, is this refundable or not?
This is refundable.
This is,
And the Vermont CDCC is refundable.
and it would have to be over and above the federal tax credit. So a low income Vermonter would have to go to 50%, even though they'll never be able to claim it. And then ours would be on top of that.
I'm not following which credits you're talking about there.
The one that's tied to the federal child dependent
Okay.
care credit. Ours, our 30% is over and above that.
Ours, we are 72% of the federal credit for the child dependent care credit for the Vermont one.
Okay,
So if you're claiming 50% of your expenses at the federal level, there's a cap that you would hit. And that would be what your corrected amount is at the federal level.
okay,
We allow 72% of it. The difference is at the federal level, if you hit that cap but you don't actually have enough tax
Yeah, you don't.
It
get-
wipes out your tax debt, but then you don't get anything back. The Vermont one, would be refundable.
And that is 30% of the same expenses.
It's 72% of that federal credit on those same expenses.
So it'd be-
But yes, on those same expenses.
30% of 72%.
No, it's just,
Okay,
Yeah,
it's just a
don't
walk.
get thrown off. The 30% for this credit we're talking
Yeah.
about. The important thing is, and the reason why I have this chart, totally different expenses.
Okay,
For
If
the
you're,
new, the new proposed. credit,
okay,
it's different.
alright, so it's not the same
the
expense.
child dependent care credit, that's one thing to know about
Okay.
this proposal is. All of the expenses that you can claim for child dependent care.
Yeah.
Are not covered by the family
Okay.
caregiver credit. It's different expenses.
Okay.
Okay, so Vermont credit is refundable. The family caregiver credit is refundable. The child dependent care credit has a phase down. There's no phase out. Once your AGI hits a certain amount, you can take only 20% of the expenses, but you can still take expenses. The family caregiver credit has a phase out where once you hit 175 AGI, there is no credit at all for you. The differences in who can receive care. For the child dependent care credit, the qualifying person has to be a dependent child under age 13 or a spouse or older dependent, physically or mentally incapable of self-care. For the family caregiver credit, the qualifying person must be over the age of 13 and related to the caregiver, but not a dependent. Has a medically diagnosed disability or health condition and does not reside in an adult care home, and then has further restrictions on their ability to perform activities of daily living. Moving on, child dependent care credit, the person receiving care must be a dependent. For the family caregiver credit, it applies to a qualifying individual who does not meet the federal requirements, which means the person receiving care does not have to be an independent. And then the expenses that you can claim for the child dependent caregiver credit must be related to work or looking for work. That is why most people use that credit for childcare expenses, because you're paying for preschool so you can go to work. Right? Family caregiver credit is qualified expenditures that are not allowed under the federal CDCC. So anything that would be considered work-related expenses would not be claimed under the family caregiver credit. You would use your CDCC for that. So it would apply frequently, I would think, in cases where maybe the caregiver themselves is not working. And so currently, if a person's not working, they can't use the child dependent care credit, even though they would otherwise qualify. Because of that looking for work requirement. With that, I'll stop. And those are the differences. We do have a couple of co-sponsors in addition to the sponsor on this committee.
Okay. Okay, that's our first walkthrough. Anybody that would like to testify, just get your name and contact information for Charlotte, and we'll get you on. Any suggestions anybody on the committee has for who we should hear from, we'll get them on ASAP. Not sure how soon that'll be, but as soon as we can. Okay.
Thank you, Kirby.
Sure.
Okay, we are not, as I hope, going to get to make a decision on reports. The reports will all go away if we don't make a decision. So they are playing hardball with us. So anyway, we're gonna go on to S204. This is an electric ratepayer assistance and utility disconnection. And Becca White is here just to give us a quick why I put this in, and then Maria will.
Hey, deja vu. I'm clearing out the room.
I guess electric disconnection isn't as. Caregiver credit.
That was an exciting bill.
We don't usually do exciting things here.
Well, thank you, Madam Chair, and thanks for having me back. Seriously, deja vu from last week. I have a bill for you to consider, S-204. It's titled the Vermont Energy Equity Law. I'm not going to go into too much detail on the individual sections, but a basic gist of the bill is that it would create a ratepayer protection program that would ensure that Vermonters who are low and moderate incomes or have low and moderate incomes, that they could afford their electric bills. The program would discount the electric bills depending on the income of the person paying. The program would pay for itself through a fee on higher income ratepayers. And the reason for introducing this bill comes from my desire that as we phase out fossil fuels, that access to transitioning to electric use is affordable for Vermonters, especially when we have electricity energy burdens that are high. And it's actually interesting, the same percentage that the governor just said in his speech I had prepared today, which is that Vermonters face an 11% energy burden. So that means your costs are about 11% of your budget. That's a serious burden on Vermonters, and I can see that that's definitely a universal concern that we just heard from the governor, and that I would suggest is the large reason for this bill being introduced. It takes into account, oh, hey, look at that, thank you. It also takes into account the rise in disconnects, which means someone's power shut off. So actually the very first section of the bill goes into when you would have further prevention of disconnection and what would actually prevent someone from having a disconnection happen. For example, adding periods of extreme heat, which you can imagine, even if you don't move forward with this bill in its entirety, I do hope you really consider protections for folks when it comes to disconnections for extreme heat, because air conditioners are a costly thing for a lot of Vermonters. And unfortunately, if someone has a disconnection during an extreme heat event and they are older, that we have seen can actually cause the death of folks. And so I really do hope, even if you don't take up every part of this bill, that you consider that potentially in a miscellaneous bill or however that might work. I do want to just draw your attention to the fact that this bill is supported by multiple environmental groups throughout the state. And the reason I introduced it was because of a Act 350 Vermont node in South Royalton, who I believe they're watching. So thank you to the South Royalton node of 350 Vermont for bringing this issue to my attention. And I would just end by saying that there is a study that you can review that was released on December 15th. And while the study ultimately did not recommend moving forward with a ratepayer protection model for the state, I still think it's worthwhile for us to consider. And I would ask you to look at their recommendations as well, even if you don't move forward with this idea.
Now you have answered a question for me, which is why I got several handwritten letters from Royalton, which is not in my district.
Hey, I got some good constituents. They're active. They're engaged.
I get very few handwritten
Good
letters.
penmanship, I hope.
It was active penmanship. I could read it. Senator.
Thank you, Senator, for that presentation. I heard the governor talk about the 11%
Yeah.
today, and obviously affordability is on all of our minds. Is that 11% for low income folks, or is it an average? You know, what?
I believe that's just that's a good question. We both pulled it out from another report, and I don't know. I think it's on the average is like 11%. I don't know.
Low to moderate income Vermonters.
Okay, I mean, that would make
So we'll definitely check that one out.
Yeah, because I think the point is well taken. My understanding is the energy burden is a higher amount for folks typically who are low income because smaller income.
Yeah.
Okay. Thank you.
Well, thank you for having me in again.
You got another bill in here?
Well, no, you got me earlier, but you know what? I'll come back if you want.
No, that's okay.
So I can introduce, I'll go to the rules.
I'm running out of time already. It's only the second week, so. It's all along. Okay.
And I'm actually going up to House Government Operations where we're getting rid of all our reports. So hopefully, I know. So someone's doing some reports today.
My committee is going to have to buckle down on it.
And thank you, Maria, for.
You're welcome. Good job. Thanks.
Hello again, Maria Royal, Legislative Council. And we'll do a quick walkthrough of the bill, which is S-204.
And I'm assuming that there are no fiscal notes because I was told they won't do one until we take it up or are ready to vote it out. So,
That's probably true, but I don't know.
yeah,
I haven't
so
spoken.
I'm assuming there are no fiscal notes on any of these.
Well, the first part is about the disconnection, so we'll get there. It's just the PUC amending its rule with some new requirements. So the utilities can probably talk a little bit more about what the burden might be on them. And then the second part is basically a study, again, for the PUC. So no fiscal impact except with respect to whatever they come up with. But we'll go through, so that you're just familiar. Again, the short title is the Vermont Energy Equity Law. And then section 2, this is maybe the section that deals with the disconnections that were mentioned by Senator White. Section 209 of Title 30 pertains to the PUC's general jurisdiction over regulated utilities, and subsection B, as you can see on line 17, pertains to required rules that the PUC is required to adopt. So there are a number of items listed. I just want to draw your attention to what was subdivision 3 on line 10, regarding the PUC shall regulate and prescribe reasonable procedures used by companies in disconnecting or reconnecting services and billing customers. So that's existing law. And based on that, PUC adopted Rule 3.300, which specifically concerns disconnections of residential electric service, water service, and gas service. So the proposal here is for the PUC to amend that rule to specify that subdivision A, a physician's certificate certifying that a ratepayer or resident within the ratepayer's household would suffer an immediate and serious health hazard by the disconnection of gas, electric, or water service, or by failure to reconnect such service, shall prevent disconnection or require reconnection as applicable, and shall remain in effect for the time period specified in the certification unless the commission rules otherwise. So under the existing rule, there is a provision that says if a ratepayer or a member of the household would suffer some kind of serious health hazard, a physician certificate could specify to keep the service on for up to 30 days is what they're allowed to do under the certificate. It can be renewed once for a consecutive 60-day period. Beyond that, you need the PUC's approval. And I think you're allowed up to 3 months in a year per total. So 2 consecutive months, 3 in 1 year. So this basically would just allow for that requirement to not disconnect to remain in effect for the duration of whatever the certificate says, the physician says. So potentially a much longer time period.
You know, I'm gonna play devil's advocate. I guess I sat on economic development with too many landlords. If you get a physician's certificate and they can't turn off your electricity for the duration, and the physician says for the duration of this person's life, they're gonna be hooked up to this machine. What prevents me from just saying, I'm not paying? And that's been a complaint from landlords. When you say people can't be evicted, then they say, well, I'm just not paying it. So that may be something to look at, because these are regulated utilities. They are not being allowed to make an excess profit. So I assume any loss gets figures into the rates.
The existing ratepayers, any cost, additional costs. I think that's a good point. The only thing I'll say is that this would be a rulemaking. So the
Okay.
PUC would have to develop the rules, and no doubt
And
the
if you go through
utilities,
all-
the landlords would be participating and trying to flesh out what are the reasonable parameters. But you're right, it doesn't specify any
Right, it doesn't specify
here.
Talk about.
Well, it says unless the commission rules otherwise, so I don't know if that's specific to us.
I suppose they could go back
Certification
in
or
and say they're just not paying it,
Yeah.
but they just bought a brand new sports car and,
Right.
yeah.
Oh, that's good. So in Western and Central Europe for a long time, you know, temperatures were fairly temperate. They just didn't have air conditioning. And what they found over the last 10, 20 years, as we've been in the midst of climate change, is that those heat spikes are really dangerous, and they have lost many elderly folks. And I don't think these are folks necessarily who had underlying health conditions, they were just old. So I wonder, this physician's certificate, that's not gonna cover old people who are really
No.
vulnerable to high heat.
Not necessarily, but I'll just draw your attention to the next subdivision,
Okay.
which gets at this issue. So subdivision B right at the top of the page, no gas, electric, or water utility may disconnect service to any residential ratepayer during periods of extreme heat as defined by the commission. So, it gets to exactly that issue. So they would have to define what is extreme heat, what length of time, and so on.
There was a statistic I heard that when the temperature got above 90, people in the north started to die because we're not used to not going out in extreme heat. In the south, when the temperature got below 30, people started to die. Same thing, you just don't understand hypothermia, and you don't have central heat, and you don't have grease linings. So part of it is what you're used to. Part of it is probably you're old and you've never had.
Me personally?
No, but I mean, you in general, you just have never had. You don't have, this is what my mother did when it got hot, the kind of thing. There's no culture tradition. Yeah, there's no culture for what you do when it's that hot. When I moved here 50 years ago, nobody had air conditioning in their cars. Nobody had air conditioning in their homes. You had a big fan and it dropped down to 60 every night. And life was good. That has changed. In March, what was it, 23rd? No, 13th. 1992, when we had the flood, the ice on the Winooski River was 3 to 4 feet thick. That ice hasn't been 3 to 4 inches thick in a lot of years. I can show you pictures. It was that thick. But that's how the temperature has moderated. I don't mind not the week below zero, but it has moderated. So we do have these issues with extreme, but not extreme cold. That's interesting because
Well, there is already, there is in
Yeah.
rule, right? There is, during the winter months, I think from November to March. There's some exceptions, but generally there's some protection already there.
Because that's what we're used to.
Yeah. Yeah. And I did, and I believe it's posted now, PUC rule 3.300, in case you want to actually look at it and more specifically.
Okay.
So that should be under my name. on
Well,
your
we'll
webpage.
have the PUC and we'll have the utilities in.
Yep.
And I think anybody from the public. That is Vermont 350.
Yeah.
I'd like to come in or zoom in now, John.
So the next section, section 3, this is what Senator White was talking about. This is basically asking the PUC to design a program for low and moderate income household. The one thing I just wanted to draw your attention to is you'll notice that section 209C is an existing statute that's being amended. So that existing statute was enacted in 2006. And it was a very similar thing. It basically asked what was then the Public Service Board, now the Commission, to design a program, an affordability program. And to submit that to the General Assembly in the form of draft legislation, as this proposal also does. And so I was curious, I went back and looked at the bill that they came up with, and which I believe is S-189, 2007. And you can see there, their draft legislation that does propose a statewide program. And they suggested modeling it after like the Universal Service Fund, which is the charge on your telephone bill that pays for a number of programs, mostly 911. And potentially a gross receipts fuel tax as well. But so that obviously did not pass. But I thought it was interesting just to see what they came up with at that time.
Okay, but
Yeah, but I don't want to end there because they did do a study recently and I believe there's a different result. Other under, but in any event, we'll look at,
we know the Universal Service Fund is in trouble anyway.
well, that's yeah. Okay, so in terms of what the PUC is charged with doing, designing a statewide electric ratepayer protection program for low and moderate income households. The program shall be developed with the aid of an electric ratepayer protection program collaborative, and then the members of that collaborative are utility representatives, residential customers, consumer representatives, LMI program representatives, representatives from programs for the elders, Department of Public Service, Agency of Human Services, and other stakeholders identified by the commission. All of those people shall aid in the development of the program, including requirements for the implementation and funding of the program. And again, as I mentioned, that's submitted in the form of draft legislation, and that will come to you the next January. And so in terms of, there are some specific things that are proposed here that should be considered. With respect to the financial assistance. So you can see those just scrolling down. It specifies that the program may include eligibility for customers at or below 300% of the federal poverty level. 2, where feasible, automatic screening and enrollment of customers. So if they're in other programs in the state that they automatically qualify, for example, if they're on Lifeline or SNAP or Medicaid. 3, funding through customer charges, so ratepayer charges applicable to all ratepayer classes in an equitable and reasonable manner, including fixed or volumetric charges. And you'll see there's some caps proposed further below. Statewide funding mechanism that applies to all or most customers in the state and that reallocates the funds collected to all utility service territories based on needs and not utility specific. It's a statewide program. Potential cap on kilowatt hours subject to the discount, exemptions from the charges, for example, for households that earn up to 8% of the state median income. a cap on volumetric charges that a ratepayer is required to pay, performance metrics, arrearage forgivenesses, administration on a statewide basis by a state entity, and funding that results in the reimbursement of the net incremental program implementation costs incurred by the utility. They would be reimbursed. And then mechanisms that ensure that any cost savings realized by utility through reduced debt and collection expenses commensurately benefit customers through reduced rates, so they're actually end up saving money. And finally, as deemed approved by the commission, any other program requirement to protect Vermont's most vulnerable households and their energy as Vermont transitions to a just and equitable clean energy economy.
When we get from the utilities, I would expect you might get some pushback from small municipal utilities in small enough town and have a lot of older people. They're not a big enough base to balance it out. You might have more concerns than the big, whatever, we got 3 or 4, Senator Hardy.
Yeah, I just want to echo what I think Maria and Senator White both said this. There was a report that came out, I think it was November 15th by the Public Utility Commission or December 1st, December 1st.
Yeah.
That talks about this issue. So they have actually, I would start there.
Can you send that?
I will absolutely send it to you. And you requested in 2024 in the miscellaneous PUC bill that the PUC do this study.
Yes.
Okay.
And yeah,
Yeah.
that is available and yeah, you should
We
probably
can just forward it to Cheryl.
I will forward it. And the other thing that I can forward to you, Efficiency Vermont has an energy burden report.
That would also be helpful.
So I think the one that I saw online is from 2023. So I don't know if they have a more recent
So we
one.
probably shouldn't check
send
that
that.
off on our list of reports and say we don't want to receive it anymore.
Oh,
Correct. I think it's a really helpful report.
yeah, but I can send that as well. I'll try to confirm if it isn't that later one.
That
but- Okay.
Quick question, when the bill refers to low and moderate income residential customers, is there a definition of low and moderate income statewide, or is that a PUC definition or?
That, I think in here it specifies, is it up to 300? Yes, on page.
Oh, yeah, right below it,
Right.
eligibility for below.
And some of the others,
33%.
if somebody told us like 80% of the county median income or there's different definitions, so we'll make sure.
So below 300% is considered for this bill, low or moderate income.
Yeah, and we'll get those numbers. We'll steal them all, the health and welfare law.
Oh, right, yes, we have that. Well, we don't have this year's yet, I don't think.
So that may be one of the statistics we're not getting it. Okay.
Okay.
Thank you. Yeah, we will take these out as soon as we plan. All right. I was good. I thought we were gonna get time to do reports, but Patrick is here. And no, this is more important than report. I'm getting the sense that no one would care if we don't send that in and all of the reports got discontinued. And then if we wanted them, we could ask for that. We are a drop in the bucket. We only have 2 pages. Health and welfare has 13.
Yeah, that's bad.
Why anyone wants a report on deaths in hospice, I have no idea, but I've been saying that for 7 or 8 years. Come on,
It's time, it's time.
it's time.
It's time.
Good, we'll see if the chair will.
Put that on.
Get rid of sample. That was
That's the
my
thing.
thing, that's
We're
why
like-
most people die in hospice. Isn't that what we have?
What it is.
I guess they're trying to keep track of how many die at home as opposed to hospice.
I think it came out of when we did or I wasn't there, when you did, when y'all did the Death with Dignity bill. And
been a
that,
long
it was part of that whole debate
Was it?
about hospice.
Alright.
I think that's where it came from. But that makes sense.
Well, we're gonna do income tax now. It's scintillating. And we've been looking at a couple things, so I thought it would be good to get a refresher as to what our tax rates look like. My sense is that our top bracket, which I've been told is only 0.25% below Massachusetts millionaires tax, but ours starts at a much lower rate. And I'm starting to be concerned, since we're hearing in health and welfare about the difficulty in attracting professionals, doctors, specialists who would probably fall into these brackets, and all things must be revenue neutral, but might be worth just because we haven't looked at this since we've looked at tax brackets and seriously during the tourist tax cut and jobs bill, we rewrote everything. And the first time we looked at it was the Blue Ribbon Tax Commission. But their job was to make us more competitive with surrounding states, which is hard when New Hampshire has no income tax, but that was their order. That's what they were supposed to do. So floor is yours, Patrick.
So Pat Didington, the fiscal office. Madam Chair, I think we can go one of two ways with this right now. So there are some slides posted on the committee page that we did look at together last year that is specific to looking at or comparing the personal income tax and property taxes. So there's that, but I also just have income tax 101 presentation that we could look at instead.
We could probably do 101. The other thing that's been brought up is what would the income tax look like if we replace the property tax with the income tax? And I don't know if you can do that, because the only proposal I've heard for tax the rich raises $70 million, which is a drop in the bucket for the $2.5 billion end fund. So I think that's something, it's been brought up enough. I would like to be able to put it to rest one way or the other.
Sure, and I mean, I guess right off the bat, so I know you were actually on the study committee in 22, summer of 22, was it?
Yeah, it was, Senator Pearson, it was his last year here, so,
That's the education income tax.
yeah.
That was on it.
That's right.
Yeah.
And so at the time, and you can correct me if my memory falters, what you all were looking at is if you replace the net homestead amount with an income tax.
Mhm.
And so, you know, thinking about that, what I did is I took Julia's most recent outlook. The net homestead education property tax there is about 720 million projected for fiscal year 27. What I then did was go into the consensus forecast and look at what they were projecting for sort of current law personal income tax revenues, and that was 1.4 billion. So if this was purely additive, and you were seeking to replace that income or that tax revenue 100%, that's essentially a 50% increase in revenues overall. In
So-
per personal income tax.
Okay, so it would-
1.4 replacement.
Just back of the envelope, it would be a 50% increase in your income tax.
Right.
Okay,
And what would be the decrease in property taxes? Would be the equivalent?
So that, what I just mentioned is if you took the homestead property tax revenues, you put them down at 0.
Oh, okay.
So, you know, that's just maybe a sense of scale. Obviously,
Well, I think that's
That would be up to you.
what I was getting the impression with the witness the other day that they thought, well, we're already moving over 100 million to buy the rate down, so why not just put the whole thing on on the income tax? And I'm saying, no, you're talking a lot more than 70 to 100 million.
Yeah, and I mean, the one thing to remember too is personal income taxes make up the largest source of general funding that we have. I think it may actually have in the slides, but it's around 50–60% of total general fund revenue is from that one type. And that's what you use for standard levels of service for government operations. It's not specific to education or transportation, it's everything else.
And we have always used property tax. Because it's harder to hide a field than it is to hide income. And we have very creative accountants in this world. Property is property. It's pretty hard to hide it. It tends to be more stable over time than income. When we did away with the property, the general fund transfer, we put the sales tax in. The sales tax over time was about as volatile as the income tax. But if we go to income tax, then we have two fairly volatile, you wouldn't have a stable funding source when the economy went south. And the few of us that were here the last time it did, taking scissors to the safety net is extremely painful. And there was a lot of resentment that the schools got an increase and everybody else got hatcheted because that was wrong. But we would have two main revenue sources would be about equally volatile and driven by the same forces.
Is that math gonna be something that we get to see, or is that just, you just did the back of the envelope?
Oh, well, Julia's outlook is posted publicly, so you have that for the net homestead amount.
Okay,
And then the 1.4 billion is just from the consensus revenue.
got it.
So that's all that is. Yeah.
We've got both documents if you wanna,
Well, okay.
but no cartoons in the consensus forecast this year.
So like I said, there is some slides that are posted already. That was specific to the education income tax. I will leave those there for reference because it does touch on some of the things you're mentioning. And I'll send these slides. I promise I'll change the header. So it's for Senate Finance. When we're done here.
Yeah, and when we did that study, it's Scott, we were looking at keeping the property tax and just saying that the upper brackets had to pay at least the 7% of their income, that the lower brackets were.
I don't remember that piece. I think we just looked at-
Because what happened was when you hit the upper end, it said you had to pay based on income. The people at the lower end who had very low value properties ended up paying more.
Right,
That's what kind of scuttled that whole
yeah,
discussion.
there's a whole class of people that they're actually paying on income.
You'll pay-
More than a property, because right now their income relative to their property values, they're a little bit opposite of,
Yeah.
there's a lot of them actually,
Yeah.
they hang out around the $50,000 to $75,000 income range.
Probably live in a double wide or.
Yeah, 1,000 square foot rambler or something,
Yeah.
an inexpensive house, but they actually have, they're making $75,000, $80,000 a year or something. Yeah.
So that's why that one didn't go, but this seems to be saying if we just raise the same amount of income on the income tax that we do on the property tax, then our problems would be solved. But if we have to raise our income tax rates by 50%, is that?
Okay.
What would our
so-
top bracket, I didn't We're already the second highest in the country.
So I mean, you can set up whatever kind of bracket system you'd like, obviously.
Yes.
When you're talking about a 50% increase in just rates, if you kept the same brackets, for example, particularly on some of those higher income individuals, you'd likely see some behavioral responses. There's kind of two that we usually think about. One is on the extensive margin, and that would be an example of that would be moving to another state. But there's also the intensive margin, which is where people will actually they delay financial decisions, change how they report their income, things like that, which is called the extensive margin. Where we actually see in that to be the primary driver of loss of potential revenue, not loss of revenue, but when you increase, maybe it doesn't go up by as much as you think. So if you're talking about a 50% increase in rates, I think we realistically project that you're not going to get 50% more income because there's going to be some elasticity that comes into play with that.
I think what's making me start to look at this is hearing that we are having trouble getting professionals. I've been told by businesses, if we're looking at moving here and you understand our top executives are paid and your housing prices are, if they can find a house, and your property taxes are, that whole tax burden is making it very difficult to attract. And in many cases, that puts us into hiring traveling services. In healthcare, we're seeing that right and left. We've one hospital that is in the press is hiring its emergency service department is staffed by a company in Chester. That's what they do. Doctors get paid a salary. They get sent to your hospital, and you in many ways lose control, and it costs more.
I think I will maybe fairly add also, it's been a little bit of a mixed bag when we look at how it's worked out in some other states. So with California being one example, I think it was a decade or two ago, they had a very significant increase on sort of top back bracket rates. And that's where some of the research on the intensive versus extensive behavioral response comes from. So they did see, it's academic research. They did see a loss in potential revenue due to some of those behavioral responses. However, more recently, you've probably heard of the example of Massachusetts, where they were forecasting 75%, half of what they actually ended up getting. So it is a mixed bag. Obviously, in Massachusetts, it's still very new, right? So that's just one thing to think about when you're also it's been kind of a mixed bag with what we've seen happen in other states.
Yeah.
How new is Massachusetts? 2 years, 3 years?
Yeah, well, I think they just closed their first fiscal year of collecting it.
Okay.
So I think we're going into their second year. And in the first year, it did come in above their
It
projections.
takes a while for your accountant to alter things. And that was only on millionaires.
Mhm.
So not everybody below that rate.
Yeah, their tax code is structured much differently. It used to just be a 4% flat tax.
Yeah.
And now with this new rate of another 4%, so 8 total, that's on $1 million plus.
So, and we don't have a flat tax. We have
No.
very graduated tax. Okay. Let's do 101.
All right, I will warn you in advance. I might try to move quickly because there are a lot of slides in here. But stop me at any point if I'm going too fast.
I'm just keeping them from having to make a decision on reports.
I can eat into as much report time as you like.
No, I need to get this done this week.
Okay, so for Vermont, our starting tax point, you maybe recall this from 2 weeks ago when we were talking about some of the federal impacts. Our starting point is actually on a federal form called the 1040. Hopefully you all submit this form every year. It's gonna have all your wage income, tipped income, just dividends, rents, all those different kinds of income you can think of. They show up on this form. And on those lines 1 through 10, which I don't know if that's big enough for you to see, but so really once we get to this line 11, that's where we get into this concept of above the line or below the line in terms of federal changes that will flow through. We just pluck that line 11 right there, and that's our starting point in Vermont. So like I said, starting point, federal adjusted gross income, that's line 11. We do add back a couple of things, bonus depreciation and interest on certain bonds. But then we do subtract some things. This is where we get below the line. So any changes at the federal level do not impact what you're seeing on the screen here. Vermont does have its own standard deduction that, as you referenced earlier, was in response to the Tax Cut and Jobs Act, where they actually got rid of personal exemptions and expanded the standard deduction. So Vermont's decoupled in that area. So you have your own standard deduction, own personal exemptions, and some other subtractions from income. Social Security exemption, one that we have being an example. And after all those subtractions, we have a Vermont taxable income, which is where we then start feeding income into the Vermont's income tax brackets. So you can see here, I have 2 examples, a single filer and a married filer. I think these brackets are from tax year 25. They do get adjusted for inflation every year. The rates don't, but the income amounts do. So you can see for married filing jointly, right at around $300,000 in AGI or taxable income, or AGI, is where Vermont's top rate of 8.75% kicks in. And then here's all the brackets. So, we just use the example of Massachusetts. Just looking at top marginal rate doesn't actually tell you a whole lot about how a state's tax code is structured. You had a flat tax, now they have one other one. Vermont has several brackets. So at the very low end, those lower income earners are only going to be paying about 3.35%. But, when looking at other states in New England, Vermont kind of sits around the middle of the road. Both Massachusetts and New York have a higher top marginal rate, although you will notice Massachusetts kicks in at $1 million, New York kicks in at 25 million. So their top rates are kicking in at much higher levels of income comparatively. But, just going back to Massachusetts, if you are one of those lower income people who in Vermont, you'd be taxed at 3.35%. They're going to be getting taxed at a higher rate at 4%. And of course, it doesn't tell the whole picture either, because we're not even thinking yet about exemptions that the state allows or credits like the child tax credit or the deferred income tax credit. So again,
Are those rates individual or couple filing joint?
so these are for
Join.
so maybe I'll just back up
Filing
for a second.
jointly, so 294.
Yeah.
For a couple filing jointly. That's 2 teachers. Teacher and a superintendent,
Yeah,
Chittenden
probably.
County,
I'm not making that. We're doing it.
yeah, it's getting close.
Yeah, pre-K through 12 system. That.
Yeah.
Okay. I mean, I'm just. I'm thinking probably won't go anywhere this year, but
And again, just remember, it's the top marginal rate. So it's really only an income above that level.
Right.
Your income below that level is going to be hitting those lower rates, but you do have to pass through that bracket. So trying to go being efficient, this is kind of looking at that same table in a slightly different way. This is again, looking at top marginal rate on a national scale. Again, this doesn't tell the full story because it's going to be hitting at different income levels.
Previous slide, why don't you have New York up there? I'm always just intrigued. The previous slide.
because we abutted.
New England states. It's just for New England states.
What would your,
Well, so I don't have it in front of me right now, but it depends on where you're living, because if you're in
Yeah,
New
they
York
have-
City,
yeah,
you're gonna have
yeah.
a municipal tax, so I
Yeah.
do know that they have a little bit. Some prevalence of local taxes
Local,
like that,
yeah.
which we don't have.
Do all the other, do any of the other New England states have a local income tax?
Like on the municipal level.
Yeah.
Not to my knowledge,
Okay,
I don't know if there's really, Boston doesn't,
so this is probably it then. Or think.
that would be my impression, but I'm happy to look at that. I just, the only other large sort of city that's in that area is gonna be Boston, right, sort of locally, and, it's like, the city needs to be an economic driver to really, attract and retain some of this high end, people. So that's where some of that comes from.
Clifton, Massachusetts is intense.
Yeah, you hit a million. bucks,
Yeah.
and they have it's constitutional, they have to have a flat tax, a flat 5.
To do that upward one,
Yeah.
they had to have a constitutional amendment.
Did they actually do that?
Yeah.
They have to vote if the state is proposing to raise revenue by more than a certain percent, I believe.
We still have town meeting. My cousin was the moderator. That's a New England thing too.
So this is just, again, thinking about the progressivity of the block tax code. It's not always just about, we're gonna tax you less at the lower income level. We do actually have credits where we're actually sending money back to, people, there's earned income tax credit, child tax credit, child dependent care credit. All these credits Vermont has a specific Vermont state level credit for. So again, that's another way that you do see sort of the slope of the progressivity of the curve steepen, meaning that the lower income people are actually having 0 or negative tax liability. I say negative, they're getting refund back because they're credits. So yeah, we have sort of 3 ways that we go about this. There are deductions, exemptions, and credits. Exemptions and deductions reduce the amount of a taxpayer's income that's subject to tax, generally reducing their overall tax liability. Whereas credits are dollar for dollar reductions of their tax liability. So I think I have an example here. There's 2 basic kinds of refundable one. An example of that being if the taxpayer's liability is $100 and they receive a $200 refundable credit, their tax liability goes to 0 and they actually get paid out that extra $100 as a cash refund. Non-refundable, same liability and credit amount, wipe out the tax liability, but they don't actually get any cash back. So I guess non-refundability is sort of one way of maybe mitigating the scope of downward revenue risk. I don't know if that's kind of a jumbled way of saying that, but it is a tool that states or the feds will use to lessen cost risk.
And I know one reason we do refundable tax credits is because they don't impact your eligibility for things like SNAP. If we do other things, we find out it was the childcare cliff that if you got a raise or if you got thrown off, but it didn't count refundable tax credits. So if we up those, we could help lower income people without causing them to lose more than they got.
Kirby, back to the conversation started, matchups. Not Kirby, Pat, thank you, that's why you were saying, I thought you were complaining about the bat. Sorry, Pat. Patrick. Okay, now I can't remember what I was gonna ask. Yes, do you have any charts that have the federal and state combined, sort of the impact of the 2 tax systems combined? Because as the federal system becomes more regressive, it'd be interesting to see how it's changing the overall regressivity or progressivity of our tax system.
So. One thing that I have seen very recently is, Ways and Means actually had, ITIP come in and, they do the, who pays report.
Yeah,
So they came in, it wasn't for that report yet, because I think that's not coming out quite yet, but, one of their analysts, Carl Davis, actually had done some analysis on, Vermonters and, their average, bill change on their federal bill. So it's not combined, but it does give you a picture of, okay, we talked about the no tax on tips is not flowing through to the state because that's above the line.
yeah.
However, Vermonters will be seeing a decrease to the tax liability. And so that's one way to look at sort of what that looks like.
Mhm. But
Now we haven't overlaid it with,
okay, because I know that the federal recent changes, but just the federal tax code in general is much more, it's much less progressive than the state tax code. And so as this new bill, lowers taxes on the very wealthy at the federal level. Our tax system is not offsetting that as much as it was before that bill. So, there are people who are really, really wealthy that just got a big tax break at the federal level. And they have therefore more taxing capacity, one might say, because they're paying less taxes overall. And so I've never seen it overlaid and and then for a state that's got a less progressive tax system, how does it impact those states as it makes their system even more regressive? So it sort of draws everybody to be less regressive, but Vermont's progressive tax system offsets it more than it would in another state.
Sure. And I guess just two quick things to that. We can always look at that in sort of a basic sort of limited scope this year. But that's a very complicated.
No, I'm sure it's extremely complicated, but it is the full picture.
What we do have coming up this summer is JFO has to write the 10-year tax study, which is a very thick report with a lot of tax information in it. And we could maybe look at something like that. I'm sure at some point I'll be back to talk to you about the report.
We could market it as cure and stop now.
Yeah. Well, I mean, I just think it's a more honest picture of people's tax picture when you're looking at federal and state together. And we kind of hyper focus, obviously, because we're state policymakers on what our state tax code is. But, sometimes the bigger impact is what's happening at the federal level.
Okay.
I think the first tax cut in jobs, state made $30 million without raising any taxes. So we rewrote the tax code to give it back. It was mostly for middle class people. It's that $200,000-300,000 income group in there.
And there's a table with that.
Yeah, they continued that because they can't deduct their state and local taxes, that they really didn't benefit the first time around, didn't benefit that much. A lot of the benefits flowed through if you owned a business with the depreciation and things you could pass through and your business. And the solutions we've seen again where you could pay those taxes through your business. But if you were just a professional who works on a salary, your position is different. And that would be just as we're thinking through, because you can use taxes to attract or detract people who is benefit. But a lot of the professionals, especially dual professional families, were getting, they were getting hit because they couldn't do those deductions. And I believe that got continued in the last bill. It doesn't like blue states, but that's also out there is a major
Yeah,
increase.
they did increase the salt cap, from 10,000, which was before the most recent bill is 40,000 now.
Oh, so you can deduct 40,000.
But that's temporary, isn't
So much of the bill is temporary.
it? Okay.
Yeah. Like the overtime tips, all that stuff is temporary.
The good stuff is temporary, the bad stuff doesn't start until after the 46.
A lot of the healthcare provider tax, which you'll become very interested in over time,
We're already-
that's certainly phased in over a period of time, yeah.
And that's in health and welfare. That's a major interest. That would be a major hit.
Here I just have a list, of some of the exemptions and credits we have on the books. Well, you did do a bunch of work on this in just last year, so this might be slightly different. For example, the veterans credit isn't on this list, the, expanded military income exemption is not included on this list. So this is not exhaustive, but these are certainly some of the larger ones. One thing that we do to make sure we're keeping track of how much all this is costing the state. I do say costing because the tax expenditure is like an appropriation. You're opting to rather than spend the money, not collect it. But in the personal income tax world, these are from the last tax expenditure report. You can see that the earned income tax credit is the biggest one in this space. And that's another one that you just expanded. So I think when we wrote this report and it came out in maybe January last year, but then you all voted to expand both the earned income tax credit and the child tax credit. So these numbers would be closer to about 30 million now with those expansions. They're the two biggest.
Do you have this for before the Child Tax Cut and Jobs Act?
Oh, sure.
Because it would be interesting to look at. There was 90% of the testimony in here was on the charitable tax credit.
Mhm.
That Vermont, or the original bill as it came here, didn't have. And every charitable organization in the state was absolutely sure that they were going to go bankrupt because if people couldn't do the tax deduction, they wouldn't they wouldn't donate and it was so focused that there wasn't a word about the medical expense deduction, which we didn't do anything on. And the next year we came back and did something minimal. So it'd be interesting to see what that slide looked like before we did the most recent. Did in fact charitable deductions stay relatively stable? I think that, we played the child tax. Now that may have come in afterwards. But that'd be really interesting to see how that worked out.
Yeah, so the good news on that is we write this report every 2 years, so we can go back quite a ways to pull all those numbers. But yeah, the most recent changes, you've made some changes last year, but in 2022, that was when the tax credit was brand new, and you also expanded the EITC then, and you also expanded child dependent care credit. So it's sort of a moving target over time, like what the tax law is and how it's structured. But yeah, we can go back as far as you like.
Yeah, I mean, it'd just be interesting to see how that did play out. Just for information as we go forward into the future and start trying to predict human behavior, which is what it is. Okay.
So this is just kind of a summary of some of the provisions that were in the Tax Cut and Jobs Act. That obviously the legislature did respond to these. The state has its own standard deduction now, it has its own personal exemption amount now. That was a response to things that were changing on the federal level. I'm not gonna dwell too much on all of these pieces, because I know we need to
That,
keep chugging forward. But
this-
they'll be available to you for reference.
that was one of the recommendations of the original Blue Ribbon Tax Commission, was that we go more to a standard deduction, or they were looking at New England states, you were allowed up to X amount, or you were not allowed any deductions. But we were the most liberal state, I think. We had the most, and I don't know that we've changed that much, but that was one of their recommendations, that be cut back on.
So that was all sort of general overview of how your income tax is calculated, some recent legal changes. This next section is just all gonna be numbers and what personal income taxes mean to the state, and how that sort of breaks down by, who's paying them. You can see here that, with a couple of noticeable jumps, personal income tax receipts have been sort of growing on a very sort of steady trend line here. You do see that significant run up during COVID. But otherwise, it's sort of a generally steady progression upwards outside of the Great Recession, right? That's where we actually saw revenue decreases. So yeah, back in 2005, personal income taxes made up about 48% of general fund revenue. And today it's more like 55%. Now, remember, somewhere in there is also shifting sales and use out of the general fund, so that does skew it a little bit. But still, it's over half of what we rely on for general services that the government provides. And so this is how it's sort of the distribution of who's paying how much breaks out. You can see that about 3% of tax returns are contributing about 42% of overall revenue per personal income taxes. So that's that 300,000 plus income group there. And when you combine that with 150,000 plus, 11%, we're talking about upwards of 60% of general fund, or sorry, not of general fund, of the personal income tax revenues. So it is, a large portion is concentrated amongst those higher earners. But one thing you will also notice, we were talking about credits earlier. Those particularly lower income Vermonters do actually have negative tax liabilities, meaning that for credits, they're actually getting more money back when they file their taxes than they're paying. And you saw that pie chart earlier. A lot of those are your refundable credits like EITC, child tax credit, what have you. So again, kind of looking at the same thing a little bit differently, you can see that the general trend is that a number of, so the bars, that's the number of filers that fall in that income group, generally decreases as the income goes up. I think we all sort of intuitively know that, right? But the inverse is true when you look at the total amount of personal income tax dollars. That's that orange line. So that goes up with income, number of filers goes down with income. And again, looking at sort of what your effective tax rate looks like based on your income, you can see that it's really until about, where are we here? Above $25,000 that you we have an average effective tax rate above 0. And again, as income goes up, this gets to sort of the question that past legislators have thought about, that I'm sure you always think about, is ability to pay. So the general thinking is that as income is higher, ability to pay goes higher. That's why you sort of see this decision, this policy decision to sort of have that line on an upward trajectory. The more you make, the more you pay, being, I guess, the kernel there. Yeah, statewide effective tax rate is about 3.8%. So that's personal income taxes. The rest of this presentation had to do with corporate. And I think that maybe is a little outside the scope of today's conversation.
Yeah.
Well, one thing though, that is apparent on the chart that you had before is the effect of the loss of the high income person. That 3%, this is at 23, a year later, that 3% of the population pays 41% of the income tax. And that's a 9,800 people. I think it's 9,900 in the food chart. And that's why it's so important, I think, to figure out if they make any change in this that does in fact increase income tax rates, how many people that would affect. And modeling that, I realize, is difficult.
Yeah, there's kind of two parts to that. Right? So we're talking about a small base. The number of filers is small, so the decision of a few of those filers is going to have sort of more outsized impact. Although going back to what I was talking about a little bit earlier, and sort of the idea of moving out of state response or just changing how you're reporting your income, essentially. That's been a bit of a mixed bag. You'll get people who will come and argue both ways too, I'm sure.
Guaranteed.
But based on the couple examples I cited earlier with California, it seemed like there was something there, particularly when thinking about reporting of income. And then in Massachusetts, you kind of have the opposite side of the argument, right? Revenues were coming in well above projections. California did seem to be more of a statistical pattern in terms of there being a behavioral response.
Those are two sides. It would be actually interesting to look at states that have characteristics perhaps similar to Vermont. In other words, a high graduated income tax rate, something that has scenic and other kinds of attractions that a Vermont would have as opposed to, and then other reasons for people leaving at the same time other than tax rates. In California, so many people left, but it wasn't solely because of tax rates. And when you start analyzing it, I'm just wondering if anybody's done this in any more depth, if anybody has done this and come to different conclusions. So you have people who have essentially different biases toward the, and it's not that everybody is unbiased who does analyses like this. And for example, the Tax Foundation, I'd be very curious what they would say to it compared to VPERT. And I bet they up with different conclusions as to
And I
why.
think Carl that was here last Thursday. He said that he gave us a name for one academic study.
Mhm.
This is why we aren't allowed to talk about that in this committee, because there's no data other than the moving companies. And everybody believes what they believe. I think we could say that if 2 millionaires left, it would have a much larger impact than if I left. Significantly larger impact. How many have to leave before? And are federal tax cuts offsetting Vermont? I mean, they get to be very personal decisions. Do you have grandkids here? Do you own a house in Florida? You could stay there 2 extra weeks and become a Florida resident.
But it's almost the kind of thing that you poll people who have left and ask them why they left. That would be probably as valid as doing the statistical
Exit
analysis.
interviews. Let's start doing exit interviews.
I don't think that's constitutional.
No? You're right, Bill.
Okay,
Do exit interviews on the interstate.
this is a little scattered. Get it a little more focused as we go forward. No, can't. We have to do the reports.
I can do that for homework tonight.
It's been homework for a week, teacher. You haven't given up your homework.
This, right? This is it.
Yeah.
We
Okay.
have no Friday.
Yep, I got on it.
Let's not get too far out over our skis here.
All right, everybody, see, I have done my, see the checks, I have my checks in
I'm on
there.
I agree with Madam Chair.
Well,
Everybody take it home.
email.
Tomorrow you will turn them all in. Okay.
Would you go